Hello everyone, welcome to PA Wealth. Past 1.5 years was a roller coaster ride for equity markets. But do you know there are many macroeconomic factors responsible behind the volatility in the markets like inflation, rising prices of crude oil, recessionary fears, etc. Usually an investor expects 12 to 15% from the markets, but it is not that easy, mainly in these challenging conditions. In overall market cycle, there are some years where capital preservations or beating inflation are more important than getting good returns from the market. As no one knows the bottom of the market, investors invest in debt funds to diversify their risk. So today in this video we will know about the debt funds and how are they beneficial to us. First, we should know what are debt mutual funds. A debt fund is a mutual fund scheme that invests in fixed income instruments such as corporate and government bonds, corporate debt securities, money market instruments, etc. that offer capital appreciation. Debt funds are also referred to as fixed income funds or bond funds. Let us know how does debt mutual funds works. Based on the credit ratings of the securities, debt funds invest in a range of securities. The danger of not receiving the returns that the issuer of the debt instrument promised is indicated by a securities credit rating. A debt fund's management makes sure to invest in highly rated credit instruments. With a better credit rating, the firm is more likely to make timely interest payments on the debt security as well as principal repayments when they are due. Let us know the types of debt funds. Mainly there are 17 types of debt mutual funds available for investors to choose from based on the maturity period, risk profile and investment objective of the investor. Liquid funds. Liquid funds invest in debt instruments with a maturity of not more than 91 days. This makes them almost risk-free. Liquid funds have rarely seen negative returns. These funds are better alternatives to savings bank accounts as they provide similar liquidity with higher yields. Many mutual fund companies offer instant redemption on liquid fund investments through unique debit cards. Ultra Short Duration Fund. Ultra Short Duration Fund invests in debt securities and money market instruments such that the Macaulay duration of the portfolio is between 3 to 6 months. Short Duration Fund. Short Duration Fund invests in debt securities and money market instruments such that the Macaulay duration of the portfolio is between 1 to 3 years. Gilt Fund. Gilt funds invest in only high-rated government securities with shallow credit risk. Since the government seldom defaults on the loan it takes in the form of debt instruments, gilt funds are an ideal choice for risk-averse fixed-income investors. Credit Risk Funds. These are relatively newer debt funds. Unlike other debt funds, Credit Opportunities Funds do not invest as per the maturities of debt instruments. These funds try to earn higher returns by taking a call on credit risks or by holding lower-rated bonds that come with higher interest rates. Credit Opportunities Funds are relatively riskier debt funds. Overnight Fund. This fund invests in securities which have a maturity period of 1 day. Overnight funds carry minimal credit risk and interest rate risk owing to such a short maturity period and are hence considered to be relatively stable. Banking and PSU Fund. Banking and PSU Fund invests at least 80% of its assets in debt and money market securities of banks, PSU, public sector undertakings, public financial institutions and municipal bodies. Other funds are medium to long duration fund, fixed maturity plans, floater fund, money market fund, banking and PSU funds, corporate bond fund, medium duration fund, income fund and dynamic bond funds. Now let us know the benefits of debt funds. 1. Liquidity. Unlike traditional avenues, debt funds don't have a lock-in period and can be redeemed at any time subject to applicable exit loads. Debt funds are considered liquid as they can withdraw on any business day. 2. Tax efficient. Debt funds can be more tax efficient than traditional investment avenues. Debt funds are taxed only when they are redeemed and the tax is only paid on the redemption proceeds, unlike some of the traditional avenues which deduct TDS on the interest earned every year. The dividend received from debt funds is taxable in the hands of the investor according to the investor's tax slab. Debt funds can be more tax efficient with LTCG, long-term capital gain, of 20% along with the benefit of indexation when the investments are held for more than 3 years, which can help provide better post-tax returns. 3. Stability. Debt funds are relatively less volatile than equity funds and can provide stability to an investor's portfolio. This can help diversify an investor's portfolio and bring down the overall risk. They are also considering being a good source of relatively stable income over a period of time. 4. Potential for better returns than traditional investment avenues. Investments in debt funds have the potential to generate better returns than traditional investment avenues. An investor can also take advantage of changing interest rates and could generate income by choosing the right fund matching his risk appetite and investment horizon. That's it for today. To know more about mutual funds, visit our blog. Link is given in the description box below. Thanks for watching. Hit like button, comment your queries and share it with other investors for their benefit. Subscribe our channel for latest stock research updates. Don't forget to press the bell icon.